Hello and welcome back to The Note. Let's explore the labyrinth of hedge funds today. This was 2013 was a difficult year for many hedge funds because, of course, all you really needed to do was make money was put money into an S&P 500 tracker fund and watch the returns shoot upwards. So it's been difficult for hedge funds in terms of performance, but they've still found ways to persuade people to buy into their product. The hedge fund sector continues to get larger. With me now to discuss what the prospects are for the sector in 2014 is the president of Hedge Fund Research from Chicago, Ken Heinz. Ken, thanks very much for joining me in London today.
Thanks for having us.
Now, let's start by taking a look at your performance indices, and obviously that line at the bottom is what you would have got but just by sticking money into the S&P. What are the patterns that we see in terms of how different strategies have performed here?
Yeah, it was an amazing year for equity markets for sure. A lot of people have a similar sentiment as what they have right now around 1998, the last time that index funds had an amazing year. And I think I was reading on the way over here that even Warren Buffett, for the first time since I think 1960, actually came out and said that he underperformed the S&P 500 over the last trailing 5-year period. So certainly it was an amazing year for equities. I think there are two stories, though, to think about when you think about the context of performance, and that's of beta and volatility in 2013. If you look at the beta of the overall HFRI fund-weighted composite, you find that in 2014, historically in the last 23 years, it's between spot 25 and spot 45, and the performance in 2013 was also within that range. So I don't think people were surprised in that respect.
Right, so less than half of their performance can be accounted for by the overall stock market performance,
Exactly.
which is a very, if you're looking for diversification, is very encouraging.
Exactly. And then the one other thing that I think is interesting, and we've done some research on this to shows that if you normalize the performance of the HFRI over the past 5 years to the much higher volatility of the S&P, you've actually done better in the HFRI fund-weighted composite if you levered it to the 15, nearly 16% volatility of the S&P 500. So it's a story of Sharpe ratio as well.
Okay, so you can still make the arguments that you're getting a safer, calmer ride for your money, even if with hindsight we know that it would have been better just to stick everything into the stock market.
I think that's the case.
Right, let's take a look now at the pattern for the industry. Obviously, the number of funds actually dipped quite noticeably after the crisis. Now it looks as though the funds of funds are in decline, which makes sense to me as they have those two layers of fees. It gets hard to justify. But we seem to be back at an all-time record for the total number of funds. What's driving decisions to launch hedge funds?
Absolutely. And on the fund of funds, I mean, I think one of the most important themes right now is greater fee efficiency. We're going to talk a little bit about this, but investors are now more challenging of the 2 and 20 model that people have traditionally associated with the hedge fund industry. And so especially for smaller firms, the only way to establish yourself and grow is to have a competitive offering for investors. And typically for a smaller fund, there's a lot of skepticism about whether or not a 2 and 20 fee structure is appropriate.
You have to earn the right to charge that kind of money.
So people come out at 1%, 10%, 15% management fee. Those are what enable funds to go from $100 million to $1 billion and begin to command that fee level.
But part of what we're seeing here then is the way in which the hedge fund industry as a whole is steadily becoming a little bit more price competitive. They still want to tell people they're worth paying money for, but they
have to. And you've seen more launches come out, and that's important because you're seeing the launch trend. You're beginning to see large fund launches come back. We talked a little bit about this earlier. After 2007, the billion-dollar-plus launches became much less frequent. It was a lot more challenging to launch a large fund and get a big commitment day one, $500 million, $1 billion. And so typically the launches are coming out $20 million, $50 million, $75 million, and then investors prefer to take the wait-and-see approach, generate a year, 18 months, 2 years of performance before making an investment rather than being a day one investor.
Okay, now let's finally take a look at the longer-term performance. The blue and red lines are two of your main indices of hedge funds. The green line is the S&P. Obviously, this crisis has been much tougher for the hedge fund industry than the previous one. They may have lost less than the market as a whole, but they still lost, and then they've been left behind in the during the rally. What are the prospects? What do we need to see hedge funds actually start to outperform even the stock market once more? How do you think they can justify an investment for the future?
Yeah, I think looking at it right now after, as I said earlier, it's kind of like looking back at the year 1997 when it was an amazing year for index funds, and the sentiment is that why be in anything other than an index fund, because it's such a powerful sentiment after a really good year. And so I think what we typically see across time is that the hedge fund industry is always going to trail in a sharp up, a 30% up year. They're always going to trail that, and then they're going to make up that ground, if you will, on the comparison to the S&P in years when the S&P declines. I mean, you've had 5 years of gains, consecutive years of gains for the S&P, and so you look back and the years when the outperformance was the greatest, years like 2000, 2001, 2002, and I hate to say it, but 2008 as well.
Right. Okay, Ken. Thank you.
Thanks, John.
Thank you very much indeed. Just to conclude, yes, this hasn't been a great 5 years for hedge funds, but it looks as though they're adapting in the ways they need to. They are making themselves more competitive on price. If, as many of us fear, the S&P begins to get very much choppier this year, maybe they will start to be offering a really competitive offer once more.